Japan has crossed a line that no one has crossed in 30 years, and the consequences are about to wipe out unprepared portfolios. On January 20th, 2026, Japan's 30-year government bond yield hit 3.9%, the highest level seen since the 1990s. That might sound boring. Something happening on the other side of the world. Why should it affect you? But what comes next might hit closer to home than you think. The U.S. Federal Reserve was forced to intervene directly in currency markets to support the Japanese yen. You heard that right. The U.S. Central Bank is using American resources to support a foreign currency, not out of generosity, but to stop a financial shock from spilling into U.S. markets. Is this normal? The answer is clear: no. This is not business as usual for a central bank. This is panic. It's the financial equivalent of calling in air support because ground troops are about to be overrun. And if you think this has nothing to do with you, that it's just some technical bond market issue in Tokyo, you're about to learn a very expensive lesson. Because what's happening in Japan is the beginning of a $20 trillion forced liquidation that could hit U.S. stocks, U.S. bonds, U.S. real estate, crypto harder than anything we've seen since 2008. In this video, you'll learn what actually broke, why it cannot be stopped mathematically, and what you need to do now to protect your savings before this accelerates, because this won't move slowly, it will avalanche, and math guarantees it. Let's start with the foundation, because without it, nothing else makes sense. Japan's debt-to-GDP ratio is 250%. That's not a typo. Japan owes roughly 2.5 times its annual economic output. Here's what recently changed. In December 2025, the Bank of Japan raised interest rates to 0.75%. That may sound normal elsewhere, but for Japan, it's the highest rate in 30 years. And they made it clear. More hikes are coming. They also abandoned yield curve control, the policy where they artificially capped long-term rates by buying unlimited bonds. They are no longer the buyer of last resort, and bond yields responded violently. The 10-year Japanese government bond yield jumped from 0.5% to over 2% in less than 6 months. The 30-year surged to 3.9%. This move is not just sharp, it's statistically absurd. Bond traders call this a Six Sigma event, something that should happen once every 100 million years. And yet, it's happening, right now, and it's accelerating. This is where things stop being interesting economic news and start becoming portfolio-destroying reality. Japan holds roughly $1.2 trillion in U.S. Treasury bonds. That makes it the largest foreign holder of U.S. debt, more than China, more than any European country. For 30 years, Japanese investors, banks, insurers, pension funds, piled into U.S. Treasuries. Why? Because it was the greatest trade in financial history. Free money. Here's how it worked. You borrow yen in Japan at 0% interest. You convert that yen into dollars. You buy U.S. Treasuries yielding 4 to 5%. The spread is pure profit. Almost no risk. This is called the carry trade, and it has been a cornerstone of global finance for decades. But the math broke. Japanese bonds no longer yield 0. They now yield 2 to 3.9%, depending on maturity. So ask yourself, if you're a Japanese investor, why take currency risk, convert yen to dollars, and earn 4.8% on U.S. Treasuries when you can earn 3.7% at home with zero FX risk? You wouldn't. No rational investor would. Risk-adjusted returns are gone. The carry trade is dead. And when the carry trade dies, selling begins. In the coming days, hundreds of billions, possibly over $1 trillion, of U.S. Treasuries will be sold. That's $1.2 trillion of forced selling pressure on U.S. government debt. But the U.S. has $38 trillion in debt. It can absorb that. Maybe. But here's the mistake. Japan wasn't the only one running this trade. Hedge funds saw it and said, let's leverage it. If you can earn 4 to 5% risk-free, 10 times leverage gets you 40 to 50%, 20 times leverage, 80 to 100% per year. And that's exactly what they did. No one knows the exact numbers. Hedge funds never disclose positions. But major banks estimate the leveraged carry trade totals $15 to $20 trillion notional. Yes. $15 to $20 trillion in leveraged bets that are now underwater and must be unwound. We already saw the trailer. In August 2024, when the Bank of Japan made a small surprise rate hike, the carry trade began to unwind. What happened? Bitcoin fell 23% in 3 days. Nasdaq dropped 10%. S&P 500 lost 8%. $2 trillion in market value vanished in 72 hours. And that was just the prologue. Now comes the storm. Here's how it hits you. You don't own Japanese assets, but you own U.S. stocks, directly or through pensions. If you work, save, or invest, you almost certainly own Apple, Microsoft, Meta, Google, Amazon, Nvidia. These companies thrived on cheap debt, but when carry trades unwind, it's not just bonds that get sold. Everything gets sold. Margin and calls hit. Cash is needed immediately. Stocks are sold. Crypto is sold. Commodities are sold. This is forced liquidation. And when trillions in leverage unwind at once, markets don't correct. They freeze. Your tech stocks won't fall because the companies failed. They'll fall because hedge funds need cash now. Real estate is at risk too. Mortgage rates track long-term bond yields. If U.S. 10-year yields hit 5.5 to 6%, 30-year mortgages jump to 8 to 9%. Home prices fall. Crypto collapses, because in a panic, Bitcoin and Ethereum are the first things institutions sell. And here's the part. Almost no one wants to say out loud. According to Bank of America, half of large institutional investors have zero downside protection in their portfolios. Everyone is leaning the same way. And when everyone runs for the exit, the boat capsizes. And it's not just Japan. Europe holds nearly $3 trillion in U.S. treasuries. And Europe isn't exactly thriving. How do they raise cash? They sell assets. And the most liquid asset, U.S. treasuries. What does the U.S. Treasury say? Hope. Literally. When asked about this at Davos, Treasury Secretary Scott Bessent said, "We're in contact with Japan. I'm confident they'll say things that calm markets." Here's the key concept you need to understand. Correlation breakdown. Normally, when stocks fall, bonds rise. But when a country's credibility is questioned, both fall together. At that point, a 60-40 portfolio is 100% risk. We saw this in the UK in 2022. Ken Griffin put it bluntly. When bonds and stocks move together, bonds lose their special role in portfolios. So what can you do? Understand your exposure. Watch critical levels, take defensive positions, allocate 10 to 20% to hard assets. Don't fall into the cash trap. There's no 100% guaranteed solution, but reducing risk is always better than ignoring it. If this gave you a new perspective, hit subscribe.